Hey, welcome back to The Dive. Today we're chatting with Marc Chandler from Mark to Market. But before we get into it, I just want to remind you that if you want to subscribe to our channel, all you have to do is hit that red subscribe button below. Hey Marc, welcome to The Dive.
Thanks a lot. Pleasure to be you.
Okay, so people began the year with a bearish outlook for the dollar. This has changed. Why?
Yeah, after the sometime in early November, whether it was the election or the announcement of a vaccine, the market became very bearish to dollar and sold it off in November and December very hard. So everybody was like on one side of the ship. And I think that we began a technical correction, but that technical correction is really fueled by this incredible divergence. Few countries can keep up with how aggressive the U.S. monetary and fiscal policy is. And because of this, it's like opening up a divergence between the U.S. and most of the other high-income countries. I was just looking at these numbers this morning, and it looks like most of Europe and Japan will probably contract in the first quarter of this year that's winding down, while the U.S. and probably Canada will be among the few major countries that really expand. And so I think this illustrates that divergence that's helping the dollar so far here this year on the back of weakness at the end of last year.
The Fed recently announced the end of the SLR exemption. Do you see this as having a material impact on the overall markets?
Interesting question, Cassandra, because the supplemental leverage ratio is really like an inside baseball, inside the plumbing of the Federal Reserve. And it really has to do with how much money the banks have to put aside for different assets they own. And in particular, what happened during the heart of the crisis last March is the Federal Reserve suspended this reserve requirement for treasury bonds that the large banks owned, as well as some of the deposits that they'd have at the central bank, at the Federal Reserve itself. So the end of this exemption, it was already extended a couple times. The end of it is not a major surprise. I think many of the banks seem to be wary of it. My general sense is that the way that us as non-institutional investors can follow it is really in watching the bond auctions. As you know, with this huge deficit the U.S. government's running, it's got to be selling a lot of bonds almost on a weekly basis. And we'll see the people's appetite, and particularly how the banks have what they want to do with their balance sheet, are buying low interest rate treasuries on their balance sheet, what they want to do with this, with their extra capital, or will they look for higher profit margin opportunities, which would reduce their demand for treasury bonds and push up yields a bit faster. So far, we have not seen much of an interest rate impact from the expiration, the anticipated expiration of that supplemental leverage ratio.
So there are rumors that Biden is looking at another round of COVID stimulus in addition to the infrastructure bill. Is there a point where all this stimulus starts to have a much greater impact on the US dollar? And do you see the dollar's role in the world economy changing?
That's what I think a lot of people are waiting for. We see the effect, at least partially, from the large deficits on the interest rates and on people's outlook for the future trajectory of the economy. All this fiscal stimulus is expected to really rev up the economy, perhaps not so quickly here in Q1, but in the middle two quarters of this year, Q2 and Q3, a lot of economists are looking for above 6% growth. We're going to be watching President Biden's focus on the infrastructure this week. And this is expected to be a very large bill, could be as much as $3 trillion. And so I think that this will be, I'm not sure about another stimulus bill. I mean, I think that this is really the optimism really here coming through, in the sense that, we're getting a lot of people vaccinated. It seems to be accelerating. We've been averaging better than 3 million vaccinations a day. It's just incredible. So it's possible that we could reach this herd immunity before this $1.9 trillion fiscal stimulus bill that was just passed sort of runs its course. So when it comes to the dollar, I'd say that in the short run, what we're seeing really is the dollar getting stronger. And partly it's this divergence because the U.S. is spending so much money, revving up the economy. The Federal Reserve still has its foot on the accelerator, also helping. But this is I think it's a fixed life story, this divergence, because what's going to happen, it's sort of like the market swings from like 2 points on the spectrum, really, at fear and greed, but also right now it's between this divergence favoring the US. But the next big move will be favoring convergence. This is that in the coming weeks, hopefully, maybe it's going to take a month or two, but Europe and Japan they're going to be rolling out their vaccines. They're going to get more success with it as well. There are going to be more vaccines available. And this divergence is really going to peak if Europe and Japan grow at all in Q2. So specifically, I'm thinking that in the short run, maybe the dollar's got some more legs. On the eve of the election, we were at about 116 in the euro. We rallied up to about 123.50, and now we're back below 118. And this is just to illustrate, really, that we're not quite back to where we were when we began this new world, both the U.S. election and the announcement that a vaccine was going to be made available. In the longer term, then I think that that the combination of the budget deficit and the large current account deficit, large trade deficit, partly is not just a function of how other countries trade policies, but it's just growth differentials. If the U.S. is going to grow significantly faster than most of our trading partners, then the U.S. trade deficit is going to widen. And I think that these twin deficits, budget deficit and trade deficit, is going to come back and haunt the dollar. I'm thinking in Q3 this year, but maybe it comes a little bit later. But in general, if the short-term divergence helps the dollar, medium and longer term, it'll go into its opposite. It'll become more convergence, and then the twin deficits will come back and bite us in the butt.
So what role do you see for the Chinese yuan moving forward?
Yeah, I think that a lot of Americans, I think, like it when we have some kind of adversary. And if there's no adversary, we'll invent one. And China, at the end of the day, is still it's a very large country. It's still a very poor country. And the currency is not even really convertible outside of China, which is why if you're going to go to China, you just can't go to the airport on your way out of town and convert some dollars into RMB, into the Chinese currency. It's not convertible, and this really prevents it from having a significant role on the international stage. One interesting development that's happened, and it's going to accelerate, is that many of the people that we have our 401ks with, our pension money, our IRAs, our retirement money, we invest in funds, and the funds they promise us relative returns relative to their benchmark. And so what's happened is that the Chinese stock market has gotten bigger, the bond market's gotten bigger, Chinese bonds and stocks are included in these benchmarks. And so if you have an international bond fund or an international stock fund, you probably have Chinese stocks in it. And so I think this is the way that China is becoming more integrated in the global capital markets. It's not so much that people want to hold on to the RMB. What they really want to do is buy, because as the indexes require you to buy Chinese stocks and Chinese bonds. And so I think this is a different type of integration than we saw, say, 10 years ago, when it was really about making Hong Kong and as the offshore center for the RMB.
So the Fed said recently we will see transitory inflation. We then saw General Mills recently say they forecast mid-single-digit inflation. Do you see that as short-lived? And do you think we will see the Fed react if we see that mid-single-digit inflation?
Yeah, this is the real bugaboo for a lot of investors this year is inflation. And the reason is that interest rates are so low that a little bit of a rise in inflation could really hurt fixed income investors. And when you think about what helped the stock market, low interest rates sort of favor high valuations in the stock market. And so what's the story with inflation? I think there's three components to it, really. The first component is like a mathematical certainty. And that is because last March, April, and May, as the pandemic was first striking, in the US, we didn't just have low inflation, we had deflation. That is negative CPI, negative consumer price index, negative prints. That is, prices were actually falling. So as these drop out of the index this year for the year-over-year comparison, we're going to see a big jump starting with this month's report closer to the middle of April. So the March, April, May, we're going to get an inflation. We call it the base effect. Last year's low numbers drop out. That's not so worrisome. That's going to be temporary. The second sort of component of inflation is I sort of think of it as a kindling wood. That is, a lot of people think that because of the monetary policy, the fiscal policy, higher oil prices, that the kindling wood for an inflation fire is there, and we just need a spark. And so some people think this faster growth will be the spark. There's also a third sort of part of the inflation story, and this is the one that's sort of bolder and bigger and more concerning, I think, for investors. And that is that, for most of my career, most of the like sort of the institutional memory goes back to the early 1980s, late 1970s. This is when we had double-digit inflation in the U.S., double-digit interest rates. But since then, interest rates have gradually been falling. Inflation's been generally falling. And so what many people are concerned about is that we're going to get an end to this, say, 40-year downtrend. And it could be because of demographics. It could be because globalization was a big part of the falling inflation story. And globalization seems to be going backwards now. And so I think these are the three elements to the inflation. Part of it is mathematical. Part of it is that these old relationships between monetary policy, fiscal policy, money supply, people think these are the ingredients that fuel inflation. And then we've got this unwinding, perhaps of globalization and some demographic issues that make people think that maybe the end of a 40-year downtrend is at hand.
So what are your biggest concerns as Q1 winds down?
Yeah, I think that we are sort of in a race right now between the vaccine and the mutation of the virus. And what's remarkable of that is how quickly I think the U.S. has proceeded with the vaccines, the rollout. We can be, President Biden's talked about the 4th of July being able to begin the opening up process. We're going to get to full herd immunity, say sometime Q3. UK is close to it as well. And that's all fine and good. But there's large parts of the world that don't have the vaccine. I think there's over 30 countries that haven't even begun administering even a single vaccine, which allows the virus to mutate. And that I think this is what we're really finding. Just like in the US, we're finding that poverty was a comorbidity. That is, if you were poor, you probably couldn't afford to go to the doctor and have checkups as regularly as other people, which made you more prone then to other illnesses, which made you prone to the COVID virus. And then these become like these people who I think cannot afford or cannot get medical attention, then become part of how this COVID virus spreads. And I think the same thing is going to work on a global basis. That a month ago, we were worried in the U.S. they would not have enough vaccines. And over the weekend, the New York Times reported that in a month or so, America is going to have a surplus of vaccines. We're not going to know what to do with them all. We're already lending some to Canada and Mexico. And I am concerned in general that that this race against the vaccine, that Mother Nature is incredibly efficient, and that the viruses will continue to mutate. And we just got to stay ahead of it with the vaccine, which requires us to help our neighbors more than some of our economic models, which suggest it's purely economically rational.
Okay, so after spending your career working with large corporations and asset managers, you joined an FX boutique, Bannockburn Global Forex, a couple years ago. What led the career pivot, and what do you mostly focus on today, Marc?
Thanks. So Bannockburn is this boutique that specializes in helping corporations, usually small and medium-sized businesses. I'll give you a good example of what happens. When we go out and I buy this tie or shirt, I know that I'm paying a retail price, and that whoever bought it, the wholesaler, paid half, maybe a quarter of the price. I know there's a big markup, a big difference between retail and wholesale. The same thing works for money. There's a wholesale price for money. The Federal Reserve lends money to banks for practically free. And then I look at my credit card, I see I'm going to be paying 21% at an annualized rate. One is wholesale and one is retail. And I found the same thing works on a slightly larger level. A large asset manager, a large corporation, the kind of clients that I've spent my career working with, when it comes to the currencies, the prices and the spread between the bid and the offer, these types of large pools of capital, asset managers, corporations, they might pay a thousandth of a penny spread between the bid and the offer. What I was struck by is small and medium-sized businesses, which are really the main employers, the largest employers in the US. These businesses are often treated like tourists. And sometimes we have found that they pay a 3 or 4% margin spread between the bid and the offer. And so I thought that after spending most of my career helping these large pools of capital, that I too became part of the problem of this incredible divergence of income and wealth in the United States. And so I joined this boutique trying to help small businesses, trying to bring to these small and medium-sized businesses sort of the institutional efficiencies, which really speaks to better pricing, transparencies, and analysis to a market segment that we thought had been like mistreated or undertreated, perhaps is a better way to phrase it. So we focus now on these businesses, and I find it a lot of fun because these are businesses that have real challenges. And part of the challenges is that they're small. It's sort of like watching those poker games on TV and seeing who's got the small stack. And you know who's got the small stack? Often retail investors, but also small and medium-sized businesses. And it's sort of bringing these institutional skills to the sort of giving David some weapons to be able to fight Goliath. I think it's a nice way to spend my days.
That's awesome. Well, thank you so much for joining us on The Dive today, Marc.
Thank you. Pleasure to talk with you today.
Thanks for watching, and check out some of our other content while you're here.